this topic I wanted to do is geared towards specifically towards business owners. Business owners have some unique challenges when it comes to retirement. And so I wanted to, really just do a call that was specific to them. So without further ado, we'll get started. This call should take about 30 minutes and, maybe a little bit longer. And then if I have time, I'll answer any questions that come into chat. So feel free to either put a question into the question area or the chat comment, and I will look to review. So without further ado, business owners' responsibilities. Quite often, I guess my heart is, it's near and dear to my heart, when I see a small business, and I always want to support local businesses. And especially after we went through COVID, it became very apparent to me that they were taking it on the chin, just with the government regulation, the restrictions put in place. And it is so difficult to be able to run a business, maintain a business, and operate, and then ultimately make a profit. You hope you can make a profit, and then can you cash out? So, what are some of the things that business owners, their responsibilities, are they faced with on a daily basis, and quite often several times a day? You have payroll. And then not only do you have payroll, making sure your employees get paid, but then you got payroll taxes, right? So paying FICA and Social Security taxes, workman's comp, right? So that's required by law. And, we want to protect our employees, but there's a cost to that. Liability insurance, right? We live in a litigious society, and I think a lot of people are always looking to figure out how to benefit, and they see businesses as somehow a way to cash in or a lottery. And then we have employees, right? The quality of employees. So employee performance, are they being productive? Are they a good employee? Are they doing the job that they're supposed to? Are they doing above and beyond? Are they just showing up? Do they show up on time? Is your business a revolving door where you have a hard time retaining good employees? And then employee benefits. This is the area that quite often, businesses are in intense competition, because one employer may start to offer a benefit that maybe your business is not ready to offer. Corporate taxes. I always share, as a financial advisor over 30 years, it's the taxes, it's the taxes, it's the taxes. And most people that start off going into business, they're not really thinking about it. They're just hoping they can, they're going to invest, they're going to make some return on that investment. And they don't realize that they also have another partner in their business, and that's the government. And the government quite often they allow you to be a little creative on how you make profit. But what I think a lot of business owners don't quite initially understand is something called depreciation, right? So you buy an asset, and then, because you have a year, a good year, you don't want to necessarily pay all that money back to the government in the form of taxes. So maybe you take an asset and are able to write it off a little bit. Then competition, right? In today's world, we have more and more businesses. And I think quite often, I think of, your plumbers, your electricians, your carpenters, your craftsmen, your handymen, your blue collar workers, right? You bring somebody on, you have this person that you're bringing to helping you, right? Day in and day out. Maybe you got two or three of them. And this one person, you're really donating your time, but ultimately they feel that they can go do what you're doing better. And so now, in essence, you've trained your competition. And let's not forget, most business owners can't afford to take vacation, but our employees expect it. So not only do we have vacation time, but then you also have sick time, maternity leave. And let's not forget about, IT, internet technology, computers, phones, the integration. And now you have, all kinds of cyber security and physical security, right? So maybe your business is even if it's a delivery service of some type, maybe your employees are carrying cash, or maybe your premises might keep some valuables on premise, right? So there's a cost for all of these things: equipment purchases, equipment maintenance. Let's not forget marketing, right? No business, I learned a long time ago, if you developed the cure for cancer and nobody knows about it, you really would have done the world a disservice. But in today's world, marketing, it's almost a overload. It's a tsunami or a tidal wave of information all the time, 24/7. When I grew up, we had three channels, and it was that, we had rabbit ears on our TV, and, maybe a TV show in between would have one 30-second commercial. Now it is, it's amazing to me that when I do go channel surfing, that as I go through a news networks, different news outlets, that like they all seem to be in sync with commercials. It is constant marketing of something. So now you can buy streaming services where you can avoid that. But then if you're a business owner trying to get your message out there, how do you create that interest, right? So that's where maybe Facebook is okay in theory, but maybe it's not performing as you thought it would, or LinkedIn, or TikTok, some type of social media. Accounts payables, right? You turn around and you buy something from somebody, you got to pay them back, right? So how do we cash flow that? How do we and now we turn around and we sell a product, and maybe we offer terms, right? And are we being paid? Are they late? I mean, supervision, right, of the operations. And you'll see on the next slide, it's just as a business owner, just the attention that we have to give to and there are many, many more, but shipping, right? All these things are demands of the business owner. And you notice I don't have on there retirement of the business owner. And that's because we're so busy running the business and wearing so many hats that quite often it's an oversight in the beginning that can quite often sort of rear its head towards the end. So that's going to bring us to some of the things we're going to talk about. We're going to talk about challenges facing small business owners. Small business owners account, numerous obstacles that can impede their success and growth. These include high failure rates, demanding operational responsibilities, and limited focus on long-term planning. Key challenges to small business owners, right? High failure rates. Many small businesses face significant challenges in their early years. I think statistically, I think about 38, almost 40% of businesses fail within the first 3 years, and 50% fail within the first 5 years. So here you are, you finally maybe left the grind, and you go into that work outlet, that outlet to try your entrepreneurial spirit. You really feel you have a good product or a good service, and it's hard, and unfortunately the stats are against you. Operational demands. Business owners frequently spend extensive hours managing daily activities with limits in capacity to concentrate on strategic planning and long-term growth. That's what I was talking about before. It's that when you're wearing so many hats in order to keep the business flowing smoothly, it's quite often quite likely that you're going to overlook things that are probably a little bit more important. Long-term planning deficits. This is where we have an expression at Professional Planning Services, and that is planning with the end in mind, right? So developing exit strategies is commonly neglected as owners prioritize immediate operational needs. And then lack of knowledge. Many owners are unaware of or lack access to crucial information and resources about business valuation, succession planning, and exit strategies. So, uncertainty of exits, concerns about who will purchase the business, who is going to buy your business. And although maybe it's a key employee, Maybe it's an outside entity. Inadequate retirement plans, right? Traditional retirement savings plans usually do not account for unique financial complexities involved in business ownership and exit. That's where we're going to talk about today. It's that point right there that a lot of business owners find out in the 11th hour that, oh my God, that they put all these other plans in place, but nothing really specifically for them, at least not as meaningful as they thought it would be. Emotional attachment, and again, we're all human beings, and we really do. I know for me personally, my identity, I view myself, I'm very proud of professional planning services. I view myself as a financial advisor. I don't see myself hanging up my cleats for another 10 years. But my identity as a human being is, if people say, what do you do? What do you do for a living? I am a financial advisor. So whether you're a baker, a plumber, a dentist, a hairstylist, right? We are that identity. So what happens when you finally step away? And what does that do to you both emotionally? Maybe you are tired and you want to move on, but maybe it's taking its toll on you from a health perspective. And then balancing act, successfully managing business growth, operational challenges, and financial planning simultaneously requires considerable effort and skill, making it a complex and ongoing challenge for owners. So the stages of business cycle and what we're going to talk about today: startup, growth, maturity. And so, these are the stages of business cycle. I am not going to go through the startup, the operational growth, the long-term sustainability, because everybody on this call, and understand your business better than most. And really the part that I want to focus on is that where that red arrow is, the exit plan. Owners have to prepare for retirement or a business sale, addressing the valuation. What's your business worth? How'd you come up with that number? And I've just seen in my career that we, in our mind, I have a client that has since passed, back in 2000, owned a dental lab. And in his mind, his business was worth about $1 million. And he asked me to try and help him to sell it. And we hired a broker, a business broker, to help him to try and find a buyer. Fast forward almost 5 years until we found a buyer, and that it gave him a quarter of what he thought it was. And when they turned around and they offered a deal, it was not a cash, all lump sum cash. It was a structured cash payment of about 5 equal payments. You also have to have strategic planning. It's critical in maximizing that business value. If you're not planning along the way to have your books ready to be inspected, it could be problematic. And then develop a retirement plan tailored to the business ownership is essential. That's what we're going to talk about here at the end. And this phase is often overlooked, but vital for long-term financial security. So, the business owner's retirement dilemma. Traditional retirement plans like 401k, there are other ones out there, but I just wanted to use this because this is what most of us in American society were familiar with. They can be expensive for small business owners. I know because here at Professional Planning Services, we offer some of the most competitive 401k plans in the country. And we still know that small businesses that are owned by one or two, maybe three people that might have 3 to 20 employees, when small business owners are looking at the cost, the actual cost of maintaining it, they get sticker shock, they choke. So, the 401ks for a small business help an employer attract and retain employees, because if they don't do it, they're going to lose that. That was that sticky factor I was talking about before. And not every employer wants to provide a retirement plan for every employee. But we have discrimination rules, right? ERISA rules for plans that says that, hey, you do for one, you do for all, right? So it really becomes a balancing or a very complex puzzle that we want to share a strategy to circumvent some of these typical plans. Typically, when an employee leaves, this is another, burn the saddle. is that you turn around, you have an employee, like I was mentioning before, maybe they're with you 2, 3, 4, 5 years. You've been maybe you as the employer are able to and generous enough to do a match up to something, but then they leave. And based on the designs of those 401(k) plans, unless you have some type of vesting schedule, they take all those funds with them. And now maybe we're top heavy, we got testing. There's just so many complexities that, again, there has to be a better way. Now, questions that every business owner faces: Who will buy my business when I decide to retire? And again, I don't like to be morbid, but quite often, business owners have a significant other that maybe they don't participate in the business, and in their mind, they're like, well, if my spouse dies, the owner of the business passes away, the non-business owner spouse steps in and tries to run the business, and in their mind they say, hey, this business, and I'll use this for an example, was worth $1 million or 2 million or 5 million or 10, whatever they think the business was worth. But they will find out very quickly that they will be forced into a fire sale unless they're able to perform at the same level as the original owner. So, what is the true value of your business? And now we start getting into some of the rules that the IRS will look at. How are you valuing your business? And is it some formula that in the future, maybe because you have a buy-sell agreement in place, but you didn't look at? Can you create a retirement plan for just me and perhaps select employees? And that is the key question there. And that's why hopefully your takeaway here today as we start to talk about Kai-Zen will be a solution that absolutely allows you to have your cake and eat it too. And we're going to go into that. So can I create a plan B if my business doesn't or can't easily sell? Again, I'm going to sound like a billboard, but this is why you're on that call, is for me to share with you some of the things I've learned right through my career and helping businesses to have a plan B. So I want everybody on this call to get the maximum value of their business when you're ready to exit. But wouldn't it be nice to not have to rely solely on that sale because maybe timing doesn't allow you or afford you the maximum valuation? Is there a strategy that can help me to leverage my business for a more secure retirement? All right, so we're almost to the demonstration portion, but Kaizen is a retirement planning strategy designed for heavily compensated employees or small business owners. Focuses on leverages itself as a critical part of the retirement strategy, just like you might use a mortgage to buy a larger house. Can you help solve a business owner's unique challenges, right? By creating a plan for retirement without having to sell the business. It empowers owners to design a custom retirement plan for just the owners. And it helps owners prepare financially for retirement throughout their working years, reducing stress about the future. So how Kaizen works: leverage planning. So it's strategic leverage during working years, custom retirement design, reduce sale dependency. And those are all beneficial things regardless of the type of business that you're in. So what I'm going to do is I'm going to hop out here and I'm going to go into a live demo. I'm going to play a video. And just from here, we're going to be able to go and let's play this here so you can, hopefully we can hear this well. So let's recircle that. There we go. Volume up and let's go.
When it comes to retirement, executives often think investing in stocks and other investments will provide enough income to maintain their current lifestyle for the average 22-year retirement. In most cases, this ends up not providing the means to maintain their lifestyle throughout retirement. And when they come to this realization, it's too late to do anything about it. Most highly compensated people don't start saving until their 40s, missing out on years of compounding interest. This result is a significant loss in retirement funds, and in their 40s, most are saving about 9% of their income. So So, how much should you be saving if you want to maintain your current lifestyle in retirement? 33% of your income. There's got to be another way to meet retirement goals without having to use a third of your income during your career. Introducing Kai-Zen. Kai-Zen is a proactive strategy that gives you access to extra money upfront, providing you the potential to earn more for your retirement, protecting your future income without putting a drain on your current way of living. This strategy helps you maintain your current lifestyle in the event of chronic illness, premature death, or inability to sufficiently save for retirement. Traditional retirement plans are typically insufficient for high income earners. Kaizen is different because it makes the use of leverage without the need for participant loans, interest payments, or personal guarantees. One of the greatest advantages of leverage is it provides an opportunity to significantly enhance your ability to save for retirement. Experts agree, when used correctly, leverage is a very powerful retirement tool. Even Forbes says you can leverage your way to a richer retirement. Your contributions are matched by the lender for the first 5 years. Then the lender uses that as a security for the additional funds for the next 5 years. The contributions are used to fund a cash accumulation life insurance policy. A minimum amount is used to purchase the death benefits and living benefits, while the majority of the cash is used to maximize your potential tax advantage growth. What could be better? Kaizen also has unique cash accumulation features within the policy. When a market index like the S&P has growth, it is calculated and credited to you. Once gains are credited, they cannot decline due to market losses. This helps keep your money safe. Would you rather have this in retirement or the potential for 60 to 100% more retirement income with Kaizen? Secure your lifestyle with Kaizen. More money, more protection, and more confidence.
All right, so just bear with me here as I get back to my screen. All right, so I'm going to take us through a demonstration here real quick on the platform called Ilya. And if you'd like access to this, this is an interactive tool. It's interactive learning information assistance. So you can get a link. Nobody will pressure you, try to sell you anything, but you can explore and see what it looks like. I want to point out here that, when you're going through here, let's just say that you're 18, you're not, but if you were on this screen, you're going to see that there is a minimum amount that can be put in, but this is for a 5-year period. We're going to get into the specifics. But in this case, I want you to see that, hey, I'm going to show us and run a scenario. I just did two business owners, they were plumbers, and they were able to put in, but I wanted you to see that at 30, the minimum that they wanted to see was 21. What they elected is they had the cash flow to do each of them $50,000 a year for 5 years. And I'm going to show you what that'll look like. So as I start to look at, okay, they were male, they were putting in 50,000, and I'm going to calculate this. So when I come through, now you're going to see that not only are they putting in their money, but the lender is matching. And that will be years 1 through 5. So, this is a key takeaway that I want everybody on the call to understand. And when I've been doing Kaizen probably 5, 6, 7 years now. And one of the first things that I was taught was, when will this plan historically or potentially not work? And the answer to that question is, if you wake up, and this is why it's so important that you're dealing with somebody that understands, and I am going to ask you these questions, is, hey, if you say in this example, 50,000, that's a total of 5 years, 250. But let's just say in 3 years from now, you can't put in that third premium, right? Then I'm going to say that Kaizen's not for you, right? And the reason is because the bank's going to make sure they're okay. They have an assignment of the cash value until you pay off the note, or the insurance company's going to get made whole, and you will get less than you put in. So just understand that. But here's where I think it's just absolute the power of magic and compounding and leverage. Just as they mentioned with the mortgage, most people can't afford a 500 or 600 or even $1 million home today, right? And definitely don't have the cash sitting around to do it. And even if you did, would you take all your cash and dump it into that property? Most people would not. So, typically they'll put in a mortgage, they'll borrow, if you're not paying PMI, 20% down and you leverage 80. So I want you to think in those terms. So you're not putting up in this example, it's not all 250 at once. It's $50,000 a year for 5 years. And then the lender is putting in 100% of those premiums from years 6 through 10. The reason, so think of that like almost 3 to 1 on your money. It's really, really powerful, and it allows for the cash inside these contracts to start to percolate, grow. And now you will see that the 250 that they put in, the lender in this example put in almost 720 for a total. Now you got almost $1 million into that contract. So let's see what that will do. So the way the contract works is we're going to pay that off in year 15. But once you start funding, the internal rate of return on these contracts in this example, based on this dynamics, but they're all somewhere between 7, 8, 9%. You'll come away in the beginning. This young man, both the brothers they got $2 million of death benefit. It's not why we did it, but it really did solve another problem for the business owner. Was what if I die? Does the one brother now want to be in business with the other brother's wife, right? Which is a real problem, and this helped us to solve that problem by creating the cash that would be needed to buy out the other brother. But here's really what got their attention, because the power of compounding, and they said, listen, if I just let this grow and we just, instead of doing a 401k, we do it for 5 years, we're done. They're out of this. Remember, he's 30. We just let this grow. They're going to be able to, at retirement, start to pull out $313,000 a year tax free. Now, is that going to be 313 exactly? No. It could be 305, could be 290, could be 320, 315. It's going to be close, because these contracts, the whole design, and you'll see here before I go, there's an area where you can go and look up all the frequently asked questions. There's not a question I think that you could come up with that hasn't been asked before you. And this has been stress tested in the worst environments in history to show that the rates of return that we're assuming, and the cost of borrowing, and the attractive borrowing rates that we're able to secure, really make this a sound strategy. So just look at these numbers here. So cumulative distributions. So for their $250,000 at retirement over the life expectancy, in this case, it's 30 years, right? So we go, hey, or 25 years, we're going, it is $8.1 million. And they still got a $3 million death benefit. To me, there's not a better strategy that I've seen in my career. And again, no personal guarantees. We're not using collateral to secure the money that we're borrowing. This is based purely on the contract. Now, the one caveat here is you must qualify, right? So you must take a medical and get through insurance underwriting. But once you do that, they are on the hook. The insurance company is on the hook, and you and your family and your business benefit. All right, but now let's just compare it to other alternatives, right? So this is an IUL, and that's an Index Universal Life with Kai-Zen leverage, right? Obviously, this strategy will outperform, right? If I were to, I offer IULs and have done so, but it's almost half. right? Because we don't have the extra capital going in early and working on compounding. And then if we were just to take that $250,000 and put it into an after-tax investment, a brokerage account, right? Even with compounding, right? You max you'd be able to get is about $2.5 million. And then you have your traditional 401ks, right? You might be able to get out a little bit, but when we're matching apples to apples, using tax-free distributions from a properly structured life insurance contract, to me is one of the single greatest gifts Congress has ever given the American taxpayer if it's properly structured. And that's why I get so excited about it. Now, over here, I mentioned this, the frequently asked questions. If you'd like a link, just when I get to the end of this, you're going to see or put it into chat. Chris at professional planning services.com. I will send you your own invitation where you can play with these numbers. No salesperson. I'm not going to pressure you. Or if you want to have a Zoom, you can do so. But before I do, I'd like to go back and just say somebody says, well, what's 18 or 30, that's attractive. What's a 50-year-old look like? And let's just say, well, let's pick a female, right? Women live longer. And the same thing, maybe they can't do 40. Let's just say they can do 30, we'll say 34, right? And 34, now the maximum for them is still 21,350. And the one thing I want to say, even though this is done annually, one of the things that one of the carriers here, Allianz, does, it's one of the few carriers that offer this. You could do this monthly. So maybe you're a small business owner that doesn't have the 50 grand. You got the cash flow, but maybe right now it's tied up in accounts receivable or whatever. You could turn around and say, "Hey, I want to do 2,000 a month or $3,000 a month because the money was just going into my brokerage account or my business account and just sitting there." Remember, it doesn't have to be in big checks. It could actually be structured to be in a monthly format. So now I'm going to calculate this again. And so now we're just going to see the same thing. So we're going through, they're matching. And then after year 5, the lender's going to put it in. So in this case, the max they put in was 170. The lender put in almost 500. So you got in about 650, 650,000. So now you turn around and say, well, what will that pay out? So now your total death benefit, it's about half of what we had in the first example. And again, a lot of people are not doing this for the insurance. And what we're doing is buying the least amount of insurance, right? So we keep the costs as low as possible to get as much cash in there as possible, right? So now for the tax-free distributions, they're able to get $44,000 a year. And you look at that and you go, oh, that couple with Social Security. And remember, because this is tax free, normally we're, under current law, you could be 85% of it, depending on whether you're single or married. Depending on how much income, you can actually have this money come to you and it doesn't affect your Social Security income. So it's really a cool and important strategy. But look at the payout here. So you put in 170 and almost got about 10 times, 8 times, back over your life expectancy, right, for the next 25 years. And then you still had a death benefit of $700,000 to leave to your heirs. So, and again, when we look at that in comparison, you got 1.1 million. If I were to design a traditional IRA or IUL, it would be 725. And then, a brokerage account or a 401k, they just can't compete, right? All things being equal. So, I wanted to just share that with you, and I want to thank everybody that's on this call for taking time out of their day. And then I'm going to go ahead and wrap this up, and I'm going to see if I have any questions here real quick. But no, so we'll go ahead and just start with, so let's benefits of Kai-Zen for business owners. It's reduced financial uncertainty. It's a customized retirement plan, enhance exit flexibility. And I think that's really hopefully your takeaway here today is that, once if you're blessed enough to find somebody that you can sell your business to, how does that deal look? And then, what's the tax implication of that? I just had a business last year that, the guys that did my copier, they did pretty well. But between federal and state, like $15 million sale of their business, ended up owing almost 50% between state and federal. It's insane how quickly the government will get their hands into the business and say you owe us, right? So as we're thinking about that, it's probably prudent to go ahead and start to separate or do a separate designated retirement account for the business owner and or a key employee, right? That person that helps you to get the business, keep it going, and to help you to maximize and take some of the pressure off that you have to get top dollar because you already know that you're going to get X amount coming from this type of strategy. And then, ultimately, like I said, peace of mind. So, the Kaizen strategy, this is just a disclosure. I'll leave this up for a second. But again, this is 5 years, therefore not defaulting on the policy. That was the one point I wanted to make sure that you understood is that we're assigning the cash value until that loan is paid off. And then ultimately, when you pay that note off in year 15, all that cash value, all the benefits now become yours as a personal asset. So I want to thank everybody on the call for hopping on. Hopefully this made sense. If you have any questions, again, you're going to see my email and everything